Hi everyone, welcome to Ask a Property Manager episode number 55. Today is January 20th, 2021. We're coming to you from Studio 2.0 here at Own Buffalo, and I'm Andrew Schultz, the principal broker of Own Buffalo, Inc. On today's show, we're going to be talking about Miami becoming a tech hub. We're also going to talk about tenant botched repairs, prepaid rent, and we'll answer some questions from landlords around the country. Before we get to all that, we're going to plug our social media. New episodes of Ask a Property Manager drop every Wednesday live on our Facebook page, 10 a.m. Eastern at facebook.com/Buffalo Foreclosed Home. You can also find the replay on our Facebook page the same day, as well as on our YouTube page. We try to get these uploaded the same day we record them. Last but not least, don't forget about our Instagram. We post things over there that we don't post on the other two platforms. The most recent episode of the Rent Prep for Landlords podcast is up. This week we're taking a look at marijuana in rental properties, tenant-caused damages due to plumbing modifications, what to do when a tenant accidentally overpays their rent, so don't miss out on that. New episodes of the Rent Prep for Landlords podcast drop every other Thursday morning, anywhere podcasts are heard, or over at rentprep.com/podcast. All right, let's jump right into our news stories for the day here. Both of them are going to come from CNBC today. This first one is interesting, and when we talk about this article, I want you to keep in context the conversations that we've had in previous episodes of Ask a Property Manager, talking about people moving out of New York City, people moving out of Los Angeles, things of that nature, moving from larger metros into other areas, especially with regards to being able to work remotely and things like that. Let's see if I can jump the size of the text up on this a little bit. There we go. How Miami Mayor Francis Suarez is luring tech players from Silicon Valley and New York. Miami Mayor Francis Suarez was leaving lunch at tech billionaire Peter Thiel's house on his way back to City Hall when he got a text from an unknown number. The person was polite, wanting to catch up and congratulating him on a job well done, so Suarez asked whom he was speaking with, to which he got back David B. Not really clearing anything up, Suarez responded, "Last name?" It was David Beckham. Suarez's schedule and phone have blown up since he accidentally launched a Twitter campaign to make Miami the latest innovation hub in early December, when someone on the app suggested bringing Silicon Valley to the Sunshine State. His "How can I help" response generated more than 2.3 million organic impressions alone, he says. It gave me the impetus and energy and incentive to keep tweeting and connecting at a very high rate, he said. In the month of December, he had 27 million impressions on his account, and he's seen a strong payoff from people coming over from the Bay Area and from the East Coast. Suarez has been working on fomenting a tech boom in Miami for more than a decade, reasoning that it could help bring higher-paying jobs for Miami residents, while also positioning the city at the forefront of innovation and the tech industry for years to come. Usually, tech employees and investors would stick to San Francisco or New York City, since they're the major office hubs, but the coronavirus pandemic opened up remote work as a possibility for scores of people. We're going to highlight that. Many left their respective cities in search of cheaper rent, more space, and a possibility to slash taxes for a bit. Now venture capitalists, venture capital influencers, and Silicon Valley elite like Keith Rabois, I'm sure I'm pronouncing that wrong, who had just left the Bay Area, have hopped on Twitter to put the spotlight on their new home. After he announced his relocation to Miami, Suarez tweeted out at him to congratulate him on the move, and the two connected for the first time. People are just happy here. At the end of the day, you meet people and they're smiling. In San Francisco, that's just not true, Rabois said in an interview on Wednesday. I've had more meetings in the last 2 weeks in Miami than in the entire past 10 months. Founders, CEOs, investors, email intros from mutuals, new connections, everyone's down here, Benjamin Kaczynski, an investor, said on Twitter this week. His recruiting pitch worked on me. MIA bound in the spring, another person said of Suarez on Twitter. Will be books written about what Francis Suarez and Rabois are doing to build Miami into the tech city of the Roaring '20s. The switch has been flipped, and it happened almost overnight, Suarez told CNBC that he often hears the theme from founders who are sick of tax policies, high costs of living, and a feeling that they're not welcome in their cities. I think the "How can I help" tweet was sort of an earth-shattering moment, because people were like, oh, finally an elected official that gets it, that understands that having companies that are building wealth and creating high-paying jobs is something that benefits a city, he said on Thursday. Some companies are even giving incentives to people who move. Startup 8 Sleep sells a smart mattress that measures sleep quality and regulates its temperature accordingly. It recently partnered with Suarez to offer a 20% discount to tech founders, investors, and employees who moved to Miami in early 2021. Twitter is a big part of why I think I'm excited and why I'm even considering this, said Amanda Goetz, who runs a CBD company called House of Wise and is planning to move to Miami this summer. The mayor is a marketer at heart. He knew how to build a product that people want and need, adding that there was almost a fear of missing out. She pointed out to both 8 Sleep founders who moved from New York and also the tech industry investor Anthony Pompilano, I am so bad with names, who announced to his more than 458,000 Twitter followers that he would move from New York to Miami for a few months. Goetz normally resides in New York City, but has been riding out the coronavirus pandemic in Charlotte, North Carolina, with her 3 children who are all under the age of 7. The original plan was to spend a year in Charlotte and head back to the city, but that plan got derailed in December when other founders began migrating to Miami. She said that until the pandemic is over, she sees little benefit in going back to a small apartment in New York, especially since most of her friends have left the city. Rabois has been very vocal about his disdain for the current San Francisco business climate, calling it overregulated and overtaxed. He said he considered a handful of cities such as Phoenix and Denver, but Miami won him over with its weather and culture. He said that he now just needs to convince people to stay for a week, and they'll commit to getting property in the area. That's happening left and right. This is not an isolated example. I've had literally 3 in the past week, he said. There's also the attractiveness of having no personal income tax. Though Rabois said that wasn't his main reason to move there. Miami had inertia. We were able to create some momentum, amplify the momentum, mostly through Mayor Suarez's abilities, and now it's accelerating, he said. Suarez said his job now is to try and keep the city's newest residents there. We're trying to keep the volume up, understanding that we've captivated the attention of a nation, and we want to keep it. Really interesting article. It touches on a lot of the themes that we've been touching on for several weeks here. People are leaving major metros where they are overtaxed or overburdened in whatever capacity. In New York State, we're a high-tax state. California is a high-tax state. Florida is a no-income tax state. Personally, I had a friend who left the Western New York market for Florida. He took a job down there, and basically between the income tax break alone was, I think, a 12% jump in his salary. So, I mean, there are benefits to living in a state that has less or no state income tax. That certainly has a lot of relevance when you're talking about a situation such as this, where people are moving from larger cities to other areas. Of course, we touched on the fact that the coronavirus pandemic is giving people the ability to work from home or work from different locations more and more, which is also a leading cause of this. And then we've also talked about in the past, you have from Los Angeles, you have a ton of people that are just making the exodus to other cities. Austin, Texas comes to mind. That seems to be the go-to for a lot of people who are leaving the Los Angeles area. So that is kind of an interesting article. I think it definitely warranted taking a look at, and maybe Miami will become a tech hub. I mean, there's something to be said for living in a state that has beautiful weather year-round and, no state income tax. I guess you do have to deal with the occasional hurricane here and there, which, I mean, obviously that's going to have an impact as well, but it is what it is. Jumping over to our next news article here. Mall of America is no longer delinquent on its $1.4 billion mortgage. This is a pretty big article. Mall of America has modified the terms of its $1.4 billion mortgage and is current on the loan after missing months of payments during the COVID crisis, as stores shut temporarily and tenants failed to pay rent. 555 Group, the owner of the largest mall in the United States, started missing mortgage payments back in April, but it had struck a deal with lenders who expressed a strong confidence in the long-term success and viability of Mall of America, the owner said. The loan has been current since December, according to TREP, a New York-based research firm that tracks the commercial mortgage-backed securities, or CMBS market. Beginning with the December payment, the loan was converted to interest-only through maturity, TREP said. Mall of America was closed from mid-March through June due to the pandemic. Retail tenant collections at the property fell to a low of 33% in April and May, according to data from TREP. Facing these unprecedented economic times, we immediately began to work with our lending partners to address the cash flow issues created by this loss of revenue, Dan Jasper, Vice President Communications for Mall of America, said in a statement. We're pleased to have been able to resolve the outstanding issues to the satisfaction of all parties involved, which included a modification of the loan terms. The Star Tribune first reported on the updated status of the loan. This is a trophy asset, and the trophy assets are more likely to muddle through the pandemic than B or C malls, Mark Manus Clancy, TREP Senior Managing Director, told CNBC. There are still about 1,000 malls operating in the U.S. today, according to commercial real estate service firm Green Street. A large majority of those malls are classified as so-called B-, C-, and D- rated malls. Actually, I think that's supposed to be B, C, and D rated malls, not minus. Meaning they bring in fewer sales per square foot than an A mall. An A++ mall could bring in as much as $1,000 in sales per square foot, for example, while a C+ mall does about $320. If you have an A mall, you see this as a vote of confidence. If you have B or C, there is no bearing. The lower rated malls are not going to make it. As restaurants, retailers, and entertainment venues have been able to reopen at Mall of America, traffic has started to rebound, especially around the holidays, said 555 Group. The company, which also operates the American Dream Mega Mall in New Jersey, is hoping 2021 will be a better year for business. Still, COVID cases continue to rise around the United States, and the threat of lockdowns being reinstated looms. The U.S. COVID vaccination effort, which was believed to have potential to spark consumer confidence, also far lags original estimates. While the coming months will continue to present unique challenges, we remain optimistic for our business and look forward to the day when we can once again welcome visitors back from around the world, Jasper said. Jump back to our other screen here. This is an interesting article. We've talked a lot about locally here. If you're a Buffalo-based viewer, we talked locally a lot about the Galleria Mall, the Summit Park Mall, the Eastern Hills Mall, which is all but dead at this point. Actually, Summit Park Mall is dead at this point. Galleria and McKinley Mall are basically the two main malls, and the Outlet Mall up in Niagara Falls, the three main malls that we have left in Western New York. McKinley is a struggling mall. I don't know technically how they're classified, but I would assume they're classified as a B or C mall. The Outlet Mall has taken a real hit this year because the Outlet Mall, due to its location in Niagara Falls, draws a lot of business from Canada. And obviously the Canadian border has been closed for months and months and months now. So that mall's taken a little bit of a beating too. The Galleria is the same way. While it's not quite as close to the Niagara Falls border, it does draw a drastically large number of clients and customers from the Niagara Falls region on the Canadian side. So that mall's obviously taken a little bit of a bath as well. It's interesting to see that malls are one of those things that Mall of America is, like they said, a trophy asset. It's one of those institutions that will probably be around longer than most other malls because it'll be able to support itself for longer than other malls. But I think as you see more and more retailers start to shift away from brick and mortar, there's always going to be a need for brick and mortar, and there are always going to be retailers that want brick and mortar space. But I think that as things continue, you're going to see an even greater shift to online and a less of an emphasis on brick and mortar, which is ultimately going to be the downfall of a lot of malls. One thing that I do find interesting, something that we don't really talk about too frequently on here, is the Eastern Hills Mall. That's actually being redeveloped basically down to its core. It's going to be mixed-use development and things of that nature. It's going to be quite the scenario to see what actually winds up happening with the Eastern Hills Mall as time goes on. I know that there have been a lot of conversations as to what's happening there. I think that project might be slowed down as a result of the pandemic right now, but we'll be watching for more news on that as it becomes available. I'm going to switch back to desktop mode here. This is something that was shared through one of the property management groups I'm in, or one of the property management mailing lists that I'm in, something along those lines. This data was put out by the National Apartment Association, one of the trade groups that represents multifamily housing developers and multifamily housing property managers, things of that nature. And what they did here was they broke down what $1 of rent actually looks like at the end of the day. And I went through and I looked at this infographic, and I wouldn't be presenting it here if I didn't think that the information contained in it was relatively accurate. So let's take a quick look at it. I know that we do get some tenants that occasionally watch our content, and this is part of the content that I'm gearing really toward our tenant watchers. And I say that because I think that most of our housing providers already understand this data, but I think that it would have a serious level of impact on a tenant to just understand the economics of how properties work. So I'm going to actually start down here at the bottom. 14 cents of every $1 goes to property taxes, which in turn supports the community through financing for schools, teachers, emergency services, other important local needs. Obviously, there's going to be some variability in that depending on your market. 16 cents of every dollar pays for operating expenses, such as property liability insurances, utilities, ongoing maintenance, and the like. 10 cents of every dollar to cover payroll expenses, including pay for employees who operate and maintain the community as part of the 17.5 million jobs that this industry supports. 12 cents out of every dollar is spent on capital expenditures, including roof and HVAC replacement and other important repairs to help ensure quality housing for America's 40 million residential rental residents. 38 cents of every $1 pay for the mortgage on the property. This is a critical expense as mortgage foreclosures put all residents at risk of losing their housing. And then last but not least, only 10 cents of every dollar, let me see if I can highlight that. Only 10 cents of every dollar are returned to owners, including the many apartment owners who are themselves small businesses and rely on this revenue to make ends meet. The investors, which include public pensions and 401ks, on which many Americans rely, whether or not they reside in rental housing, are also based on this as well. 10 cents of every dollar. 10 cents of every dollar of your rent actually is what would be considered profit margin, if you will. 10 cents on every dollar. That's pretty consistent. When you look at a property here in the city of Buffalo, and you can go back and look, I've done several property analysis videos in the South Buffalo market. When you look at that market and you look at those market analyses, you can see that the return typically in the city of Buffalo hovers around 10%. Might be a point low, might be a couple points high, somewhere around there. That's what you're looking at as a cap rate in the city of Buffalo. This infographic is pretty accurate. I mean, obviously there's a little bit of flexibility when you're talking about things like taxes and operating expenses, but more and more what we're trying to emphasize here is that your entire dollar that gets paid for rent is not going directly into your housing provider's pocket. There are a lot of expenses that come out of that, and it's a very negligible sum at the end of the day that winds up actually resulting in profit margin. So just something to consider as you are thinking about what your rent dollar actually pays for. Guys, I need some help. I'm getting ready to do a bathroom renovation in my own residence, and I seem to think that this is the perfect toilet for my new bathroom. There seems to be some discussion in the household. There seems to be some dissent in the household, I guess is probably the best way of putting it. I seem to think that this would be the greatest way to wake up in the morning. Other people in the household have a little bit of a difference of opinion. What do you think? Should I get the skull toilet? Should I install the skull toilet in our new bathroom? Keep in mind, it's not going to be the main bathroom. It's going to be a secondary bathroom located in a basement. Is that something that we should install? Should I put the skull toilet in my basement? Comment down below and let me know. I think that I should, but obviously I don't know as though my opinion is the one that's going to be the approved opinion in this instance. I just happened to find this one a couple days ago. I don't remember if this was on one of the groups or wherever, but this is literally the gate to nowhere. Just a little bit of humor to share with you guys. It baffles me why someone would do this, to be honest with you. But hey, you never know. Some people are just a little bit special when it comes to their housing repairs. I bet you that this was something stupid like the town required a gate for some reason. I don't know. It's just one of those weird things that you see on the internet and it makes you go, Let's jump into our questions from housing providers around the country. We're going to start with this one about tenant botched repairs. How should I address this? I have good tenants overall, and they let me know when issues happen with the house. They always pay. However, when I told them about an upcoming walkthrough, he told me that he had damaged a bedroom door and tried to replace it himself. He said it does not look good. When I went to see it, it did look terrible. It was a nice effort, but the door is cut too short and not installed straight. Do I charge him for repairing it now or wait until they decide to move and take it out of the deposit? They are not asking for it to be repaired, but it just looks bad. Thank you in advance. Fix it now, charge it back to the tenant. The reason that I say that is because the tenant shouldn't have been doing the repair in the first place. So definitely advise the tenant that they should not be taking on work in the home themselves, and they should call you whenever something like this happens. Chances are this was a hollow core door that somebody fell into it, or God forbid somebody punched a hole in it or whatever, not a major repair. But when a tenant decides that they're going to take the responsibility of doing home repairs on themselves, it does open up a whole bunch of risks. So advise the tenant that they should not be doing any work on the property themselves. Then I would go ahead and fix this now and charge it back to the tenant now. I would not wait until they move out, because what you're basically doing is taking cash off of the security deposit, which leaves you with less ability to do repairs and things like that after the tenancy. Do it now, fix it now, charge it now. Security deposit should be used for damages after move out, not in the middle of a tenancy. At least that's my opinion on it. That's how I would handle it. I would go ahead, get it fixed, and then just back bill it to the tenant now. Drywall in basements. I'm about to sheetrock my own basement renovation, and I'm wondering if I can actually use regular drywall as opposed to the purple moisture-resistant or mold-resistant drywall. We live in Long Island, New York, and the basement has 2 egress windows as well as central AC and baseboard heat for reference. So I'm going to switch over to, let me see here. I think I have a picture. I do. I have a little bit of a picture of what they're looking for in terms of their basement renovation. You can see they've got the studs out and stuff like that. I'm going to switch over to desktop screen here real quick so you can see just some pricing on sheetrock and things like that. So what we have here, this is what would typically be your normal sheetrock, your gypsum board, at about $11.87 a sheet. That's a 1/2 inch by 4 by 8. You then have the, let's see, ultralight. I thought that I had pulled up an image of the moisture resistant one. Give me 1 second here. I'm just scrolling around a little bit. I'm sure this is super interesting to everybody. All right, let me just open another Home Depot window. Moisture resistant drywall. There we go. That's what I'm looking for there. Well, apparently it's not going to actually take me to... All right, we'll go with this. So this is what your typical drywall is going to run you, about $11.87 a sheet. And then this is the ultralight mold tough stuff. This is a little bit more at $16.28 a sheet. Realistically speaking, you're talking about a $5, a little less than $5 difference per sheet. When you're talking about putting that into an area where you have the potential for moisture because you are in a basement, I would go with the moisture resistant, even if it's not necessarily the code requirement in the state of New York. The moisture resistant drywall, the nice thing about having the moisture resistant drywall in the basement is it's moisture resistant. So if you do have an issue, hopefully it doesn't become a major issue. I have heard some people say that they prefer the regular drywall in their basement because if there is a moisture issue, it shows itself very quickly. You'll see the damage on that non-moisture resistant drywall faster. Gives you the ability to get in there, address the issue, cut out whatever's damaged and replace it. So I guess there are 2 schools of thought on it. My personal preference would be to install the moisture resistant stuff anyway, regardless of whether the code requires the moisture resistant stuff in the basement. It is good to see that you had gone through the process of having the egress windows and things like that put in. That's a good way of going. That's obviously going to make you code compliant. Central AC is going to help with moisture levels as well as baseboard heat as well. So you're going through all of the steps that you need to actually properly finish the basement the way it should be. And I think that ultimately going the moisture resistant drywall, it might add a little bit of cost onto your project, but I think that the nice thing is you just don't have to worry about the drywall at that point. So I would go with the moisture resistant stuff regardless of what the code requirement is there. Oven glass explosion. How does this happen? Both the inner glass and outer glass are intact, but the middle glass shattered and is now falling out the bottom of the oven door. The tenant says his cousin was there cooking and kept opening and shutting the door and it just broke. And I do have a photo of this one as well. You can see that the middle pane of glass in the oven door has shattered and it looks like it's just falling out the bottom of the door. And really what it boiled down to, the question at hand here was, is this the tenant's responsibility or is this something that it would be considered normal wear and tear? I look at this as a normal wear and tear type of a thing. This is likely not caused by your tenant. I'd be hard pressed to find a way that a tenant could break the middle pane of glass without disrupting the outside and inside panes of glass as well. Opening and closing a stove door is not considered abnormal use. That's very much within what you would expect someone to do in the normal usage of an oven. Basically, what I'm getting to is glass can sit and develop little micro cracks and micro fissures over time from repeatedly being heated and cooled. Sometimes when that happens, eventually one of the cracks will get to the point where it's large enough and it'll crack, it'll blow up. Then you are dealing with the oven glass explosion that you have now. It's not a common thing. I have seen it happen before, and I don't think that this is something that would necessarily be a tenant-caused issue. I don't think this is something that would be back billable to the tenant. One thing I do want to mention is we'll go ahead and remind you of the appliancepartspros.com website. We mentioned this, I think, last week, maybe the week before, in a prior episode. This is where we usually go to try to find pieces and parts for our appliances, rather than, assuming it's not under warranty, rather than going to the manufacturer directly and sometimes paying an even more outrageous price. Obviously, when you start talking about replacement parts for appliances, they get expensive very, very quickly. But if I was in your shoes, if you were looking to do a DIY type project, I would check on appliancepartspros.com first, see if there is the ability for you to buy the glass pack that you would need to replace in that door, and then just YouTube it. Generally speaking, you're talking about a few screws to open up one of those doors. Have a shop vac handy to take care of the broken glass, and just go from there. So is it a project you can DIY? Yeah, probably, if that's something that you are in the mood to do, essentially. Otherwise, as far as the tenant side of things, I don't think that this was a tenant-caused issue. I think this was a normal wear and tear issue. Well, abnormal wear and tear, I guess, considering it's exploded glass. But I don't think it was a tenant-caused issue, is really what I'm trying to convey there. Prepaid rent. Hello all. I thought I saw something on prepaid rent before, but I can't find it now. I have an applicant that replied to my screening questions and said he likes to prepay his rent months at a time, and that we can discuss if I'm okay with that. He works for a mortgage company and has a security deposit in first month's rent. I've never had anyone want to pay prepaid rent. I was wondering what I should be on the lookout for, if anything, when I meet with him. It just makes me wonder when he puts in that we can discuss it. It's a very poorly constructed sentence. I'd appreciate any thoughts or advice. Thank you very much. So there's a couple things that we need to talk about here. First of all, prepaid rent is automatically a red flag to me. Anytime somebody tells me that they want to prepay 6 months or a year of rent up front, I almost always assume that it's because there's something that we're going to uncover during our tenant screening process that would be a reason for a denial, whatever that may be. Generally speaking, the people who are throwing around a whole bunch of cash have a reason that they're throwing the cash around. And it's generally because there's something that would cause them to not otherwise be approved for the unit. So the one thing I would say is follow your screening criteria to a T. Make sure that every single thing that you verify checks out the way that it's supposed to, and watch for those red flags. Watch for those things that might pop up that just don't make sense, or something doesn't jive, whatever the case may be. Follow your policies, follow your procedures, just the same as you would any other tenant. All of that being said, you're probably going to want to take a look at your state law and see what the state law says with regards to prepaid rent. Some states, New York included, have started to limit the amount that you can have on deposit from a tenant. In New York, we're limited to 1 month in reserve for security deposit. Also keep in mind that prepaid rent could have some tax implications for you. So if a prepaid rent is considered income the year that you receive it, regardless of what month it actually applies to. So if you get, in June, you get 12 months of rent, you're basically paying the taxes on that entire 12 months of rent, even though the next 6 months of that rent, the final 6 months, aren't going to be technically used until 2022. So that's something that you'll want to talk to your accountant about, just to verify that that is the case, or if you might have some sort of a different scenario based on your own tax situation. Talk to your accountant on that. Talk to an attorney, or look up your local regulations with regards to prepaid rent to make sure whether you can or cannot accept prepaid rent. And definitely screen that tenant all the way through, top to bottom, left to right, to make sure that you're not missing anything that would cause you to decline this tenant, even though they are offering that big prepaid rent up front. Don't be blinded by a sum of money. Do your due diligence just the same as you would everybody else. You're probably going to thank yourself at the end of the day when you realize that there was a big reason that that person was trying to get in using prepaid rent and without going through the traditional screening criteria. That pretty much wraps things up for this week's episode of Ask a Property Manager. Thank you all so much for joining us. We truly do appreciate it. We love producing Ask a Property Manager, and you can certainly help us to improve. Drop a question in the comments either on Facebook or YouTube, and your question may be answered in an upcoming episode. If you enjoyed this content, or if we brought some value to your day, do us a favor and hit that thumbs up button. YouTube and Facebook both push videos based on community feedback, so every like, comment, subscribe, and share helps us to grow and reach more people. We'll be back next week with an all-new episode on January 27th. That's next Wednesday at 10 a.m. Eastern Standard. We'll be live here on Facebook with replays on Facebook and on YouTube the same day. Thank you all so much for watching, and we'll see you next week.